Let me, before I jump into the paper, let me say a couple of words. First, I'd like to thank the Central Bank of Chile, the contributors to the program, and in particular the board of the bank because of their continued support for this conference, which has become really a landmark in the circuit of conferences of central banks. And I think this conference is not an exception to that rule. I'm very happy to be here with you. The other thing I want to say is when we first started to think about this conference with Gianluca and Sofia, this was 2.5 years ago, more or less, maybe more. And so we were very excited about the research that was done at the bank, looking at the heterogeneity in the microdata, the very rich microdata that the bank has put together. There were many exciting projects going on, many ideas, and we had a lot of fun with Gianluca. He came and gave us a course on Hank models, and when we were discussing about future research agendas, it came natural to think about this conference, to get together an excellent group of researchers in topics of heterogeneity and macro, and help us continue push forward the agenda, and also showcase a little bit of the very ambitious agenda that we had set several years ago. So with that in mind, and also it gives a great excuse for me to come back to the bank and see many of my former colleagues and friends. So with that in mind, let me jump into the paper. This is 2 cents of this very ambitious agenda that but many other researchers in the bank started. This is going to be a different paper from the others because we're going to look at firm heterogeneity, trying to pin down the financial channel of monetary policy. This is joint work with Boragan, Aruoba from Maryland, with Bernabé, López, and Will Lu, 2 former colleagues of mine here at the bank, and Felipe Saffie from UVA-Darden. The usual disclaimer applies. This is our views and not the bank or the IMF. It's the first time we're going to present this paper after much work. It's still work in progress. I'm going to talk about at the end of the things that we're still doing, but very much looking forward to your comments. Okay, so let me begin by motivating this topic with a couple of observations. The first, very uncontroversial, any textbook macro that you can think of, introductory textbook macro, that talks about the transmission of monetary policy, talks about firm investment. And the assumption there is that the monetary policy rate has a direct impact on the opportunity cost of resources, and hence, if this opportunity cost increases because the bank increases the monetary policy rate, well, then fewer investment projects are going to be made, and hence aggregate investment is going to fall. This is in the textbook example. The second observation is that because of that, there has been a lot of effort in trying to understand this transmission of monetary policy. Several researchers in this room have made great contributions towards that end. And in that process, a perennial question is how much financial factors matter in this transmission mechanism. Very excellent papers have been written on this topic, both theoretical and empirical. And in particular, a question that we will be asking and we will be zooming in quite closely is, for instance, how much does the access of debt matter for the transmission of monetary policy through this financial channel. Does having more debt, does the fact that firms have more debt in an economy matters for the transmission mechanism? Does it amplify or dampens the transmission mechanism of monetary policy? And this is not just an academic question. It's actually a very policy-relevant question, particularly nowadays where central banks have been tightening their monetary policy rates in an environment of corporates that are highly indebted because of the COVID-related debt issuance. So should central banks tighten more aggressively or less aggressively in this environment of highly indebted corporates? I said that many people have contributed to an understanding of this financial channel, yet I think it's fair to say that it has proven to be a challenging task because at least two shortcomings. First is you need very detailed data to really pin down this financial channel. You need data, you need high-frequency data on investment at the firm level. At the same time that monetary policy is changing, so at very high frequency. And you need, and this is very important for the message of the paper, you need to look at the universe of firms. If you look at a subsample of firms, which is what is generally done, you will likely have biased results because the firms that researchers generally have access to are large firms that are well capitalized, have access to financial debt, so that might bias the identification of this financial channel. There's also a lot of modeling challenges. If you really want to look at the entire cross-section of firms, you need to account well for particularities in their life cycle. For instance, how investment is lumpy, how their access to finance might be highly heterogeneous across firms. So with this in mind, with these observations in mind, what is it that we do in this paper? We're going to do two things. We're going to do a lot of empirical work and also some theoretical work, some modeling. Let me highlight the key takeaways from both endeavors. On the empirical front, we're going to quantify the impact of monetary policy surprises on firm-level variables such as the rates at which they borrow, so the pass-through of the monetary policy rate to the rates at which these firms borrow, their investment decisions, as well as their hiring decision in the labor market. We're going to do this because, or aided by a fantastic data set or several data sets on both real and financial variables for the universe of firms in Chile at a monthly frequency. We're going to have loan-level information, very rich and detailed in terms of quantity, maturity, and rates of these loans. Importantly, this is going to allow us also to capture non-performing loans or the non-performing status of firms as a proxy for their imperfect access to credit. And we're going to couple that with monetary policy surprises that I'll say a few words. On the modeling side, basically the contribution is going to be to build a heterogeneous firm model where firms are going to have, there's going to be a heterogeneity in their access to finance. And among many other characteristics, they are going to endogenously decide whether they enter the credit market. And if they enter, they're also going to decide whether they default and hence are excluded. So this is going to be central in the modeling, trying to capture what we observe in the data. We calibrate the model as much as we can to this very rich microdata from Chile. And what is going to be central in the lessons that the model is going to deliver is that the fear of losing financial access is going to be central in shaping the transmission of monetary policy through the so-called financial channel. In terms of the real variables, we're going to document the high pass-through to firm-level loan rates after a monetary policy surprise. We're going to quantify this dynamic effect of investment and labor following the monetary policy surprises. We're going to show how financial access by these firms and the heterogeneity in this financial access is going to be central for the transmission of monetary policy. We're going to establish, as a result in coming from the data, that having access to debt is what determines, after all, the dynamic response of investment and labor. So this imperfect access to debt is going to be central in shaping the transmission mechanism. We're also going to establish that there's an additional or a complementary view of the financial channel of firms that are accessing debt, but that somehow are more risky than others. So we're going to capture this through a proxy for deteriorated debt. What we're going to find is that risky firms, that is firms with relatively higher spreads, are going to decrease investment by more after a monetary policy surprise, and they're going to increase investment by less after an expansion, right? And we're going to capture this in the model, in the theoretical model, by something that we're going to call default aversion. That is, firms with higher default risk, with higher spreads, are going to decrease their investment more to avoid losing financial access. So there's going to be this fear by firms of losing financial access. And we're going to do what Ernesto was saying in his discussion. After learning this from the model, we're going to go back to the data, to the microdata, and try to validate this mechanism that we learned through the model. And last but not least, we're gonna look into the policy relevance of these implications, particularly discussing the way in which the distribution of debt matters for the calibration of monetary policy. Okay, so just a few words on the literature. There's many and several important papers that our worker is going to speak to. Obviously, first and foremost, the seminal contributions of Bernante, Gerkler, and Gilchrist on the financial channels. There's a set of very nice, relatively new papers that have started to look at financial variables and firm heterogeneity from an empirical perspective. There's also some nice quantitative work. Perhaps the most well-known is that of Pablo, my discussion with Weinberry in Econometrica, that taught us how to start to think about how to model this financial channel. And the last literature strand that the paper is going to talk to is that of quantifying monetary policy surprises in high frequency, which we're going to do leveraging on earlier work that we have with other colleagues at the bank. Okay, so let me jump into the data. I need to say a few words about the data because this is really the core. So we take advantage of this massive effort that the bank has done over the years. And here I need to praise many people, starting with Elias Albagli, the chief economist that has pushed for the bank to have this repository of administrative data set that we can now do research, but as well as policy to inform policy discussions. But many others have contributed to this effort. What we're going to do then is we're going to merge several data sets on both real and financial firm-level information for the universe of firms in Chile at a monthly frequency. Very quickly, I'm going to go through the nature of the three types of information that we merge. We merge tax records, the credit registry, and monetary policy surprises. So tax records are going to give us monthly information, mandatory forms, that are going to inform things like sales, purchases of inputs, purchase of machinery and equipment. We're going to have also access to a match employer-employee data set that, among others, it's going to inform about headcounts, wages. We're also going to have balance sheet information at an annual frequency, which is going to be crucial for several controls that we're going to run. We're going to clean these data so that we end up with real firms, firms that have at least 3 employees, that report consistently, that invest at least twice in the sample. The credit registry is going to merge 3 data sets: the monthly bank debt stock, consolidated at the firm level, so we're going to know what is the debt stock of each firm vis-a-vis the financial system. Importantly, that's going to tell us not only the type of debt, but whether it's what we're going to call deteriorated debt, whether it's debt that is defaulted, restructured, or in arrears. We're going to have access to loan level information, so flows, very rich in detail about the amount, the interest rate, the type of the loan, the maturity. There's a shortcoming with the data set for flows, which is it starts around 2012. All this data, most of it starts in the early 2000s, except the flow data. So that's going to limit our analysis. I'll mention a few more words on this. And we're also going to see domestic and foreign bond issuance. So essentially, we're going to have the 360 degrees look at the sources of finance for these firms. And we're going to merge this, or we're going to complement this firm-level information with monetary policy surprises. With others in the bank, Ernesto and others, we did an earlier paper where we looked at, we took a deep dive in measuring monetary policy surprises in Chile. After several attempts at quantifying these surprises, we ended up choosing the Bloomberg forecast, which is, in case you don't know, it's a forecast that allows market participants to provide what they think is going to be the monetary policy rate, and this allows these market participants to provide their forecast just a few hours before the monetary policy is announced, the monetary policy rate is announced. I need to be clear here. We're not saying that monetary policy in Chile is done through surprising market systematically, that this is a constant feature of monetary policy. In fact, since 2009, where analysis is going to start, we have only 15 surprises, 5 positive and 10 negative, right? So we have only a few surprises, but these are precious for us because these are the instances where we can pick and identify the transmission mechanism of monetary policy. Okay. I don't have much time to go through the descriptive statistics of this data. Let me just present 2 that I think are important for the story. This is leverage, total debt to assets, and employment. So this is their distributions over the near 5 million of observations that we have in the sample, or close to 60,000 firms. And two clearly distinctive patterns emanate from these plots. First, both distribution plots are highly skewed towards the origin, so very little or no debt, and small firms as per employment. On debt, 25% of the observations in the data set come from firms without debt, but up to 60% of the firms that we observe through their life cycle at some point didn't have debt. And this is essential if you want to build a theory about the financial channel through the universe of firms. You need to account for the fact that many of these firms don't have access to debt at some point in their life. And it also needs to account for the fact that these firms are relatively small. Okay, so let me jump to the empirical analysis. I'm going to walk you through 5 empirical facts that we think characterize or allow us to identify the financial channel. First, the obvious starting point, which is there evidence of this transmission mechanism, of this pass-through from monetary policy surprises to the rates at which these firms borrow. So this is the first assumption that I mentioned. It's in the typical textbook, right? So for that, what we're going to do is we're going to go through to the loan level information. As I told you, this loan level information starts in 2012. That restrains a lot the amount of the number of surprises that we have available. We're going to zoom in on 3 surprises in particular, and we're going to do an event study analysis by regressing the rate of firm J in period T to a dummy that takes the value of 1 after the monetary policy surprise takes place. And we're going to run this event study between 30 days before the surprise takes place and 90 days after it takes place. And importantly, we're going to look at firms, only firms, that we see borrowing before and after the surprise, right? And we're going to control further by firm fixed effect and the size and the maturity of the loan. So this is the ideal setup to try to quantify what would have happened had monetary policy surprises not occurred. The way we plot the result is by scaling the estimated coefficient on the dummy by the size of the surprise. So 100 here in this scale, in the vertical scale, means there's a 1-to-1 pass-through, right? And as you see, the pass-through is quite big and takes place within more or less the 20 days. Yeah?
Surprise as opposed to a 1-0 dummy? Because you know expectation, then you have the ex post, you can compute the size.
We could, but we're scaling, in the way we present this, we're scaling the beta by the size of the surprise. Okay?
So it is the size of the surprise effect.
It is.
Okay.
Right? So it's telling you how much of this surprise, whichever the size was passed through, right? So this is the first smell test that there might be a financial channel behind this, right? It's not a definitive proof of a financial channel, clearly, but without this, we couldn't claim that there is a financial channel. Let me move on to the second result, which has to do with the investment response, right? So we're going to move from the loan level information to the monthly information. We're going to use the 15 surprises that I mentioned, and we're going to run local projections of this object, which is the investment in firm J, scaled by the assets of that firm. We show in the paper that this is proportional to the change in the capital stock, H periods ahead. And we're going to, the key element here in this regression is going to be the monetary policy shock here, epsilon, right? And we're going to use firm fixed effect, industry quarter fixed effect, and several important controls that allow us to include some of the hypotheses in the literature. So we're going to have age, we're going to have size, we're going to have assets, sales to assets to account for possible liquidity mechanism, which has been postulated by others. Okay, so what you have in front of you is the local projection results up to 36 months of horizon. two things stand out here. First, the shape of this response. It starts to become significant. These are 95 confidence bands after 11 months and stabilizes somewhere around the 23rd month. This is remarkable given that the monetary policy horizon in the framework that the bank uses as monetary policy framework establishes a horizon of 2 years. So this is a good validation of this. Now, in terms of the size of these, if you back out this in terms of the decrease in the capital stock that this coefficient implies, you get a pretty sizable result, and a decrease of the total stock of the firm of around 3%, 3.2% after 24 months. So let me move on to result number 3 that follows from the previous result. We now want to assess how much of this impulse response, of this dynamic response of investment, can be traced back to having debt or not. So the first question that I asked in the introduction, how much does having access to debt matter for the transmission channel of monetary policy? And what we do is we expand this local projection by including a dummy, which essentially takes the value of 1 if in period T, firm J had debt or not. And hence, the total coefficient that we're interested for these firms with access to debt is the sum of beta H plus beta HD. This sum is exactly this local projection. On your left, you have the previous result that had established that there is a dynamic response of investment. What you have in orange is those firms without debt. So only this coefficient, the beta H. What is clear from this is that the entire dynamic response of investment is driven by firms with access to debt. Now, of course, you might be thinking, well, but having access to debt is not or may not be considered as a binary outcome, right? You might have access to debt, you might have debt today, but as a firm, you might be a little bit more constrained than the firm next to you because, for instance, you might have a more difficult financial situation, right? So you might have defaulted, you might be in the process of restructuring, that might prevent you from fully accessing the financial system. Okay, and so this is what we're going to zoom in. We're going to look at the extent to which, for those firms that have debt, how much action do we see in heterogeneity of this ability to access finance. And for that, we're going to include a variable that here is DD, that's deteriorated debt. It's a continuous variable that is computed as the sum of defaulted debt plus restructured debt plus debt in arrears over total debt as a way to capture the potential problems that these firms that might have deteriorated debt have in accessing the financial system. And we can show you, and we can come back in the Q&A, we have some statistics that show that these firms with high DD, deteriorated debt, have less probability of accessing debt and have higher rates, right? So what we do is we want to explore this coefficient, and I should say that this time fixed effect is now monthly to fully absorb the effect of the monetary policy shock. And what we're interested is in this new coefficient, which is going to capture this differential access coming from deteriorated debt. And we do see that is significant. It increases. So if you think about a monetary policy surprise that is contractionary, that decreases investment, this dampens the effect of the monetary policy shock. right? So, and it's also economically meaningful, the coefficient. A firm with 50% delinquent debt will invest half of a percentage less relative to firms without delinquent debt, right? So this channel also works through this non-binary access to debt. Last result, in a compact way, what happens to the labor market decision, so the hiring decision of the firm. This is very novel. To our knowledge, this is the first paper that has looked at labor outcome results following monetary policy surprises at very high frequency, at monthly frequency, which is key to uncover this financial channel. And what we have qualitatively the same results. We see a negative impact on employment growth following a monetary policy surprise. If you want to quantify this, 100 basis point increase in the policy rate decreases employment by 1% after 12 months. And this, importantly, this channel is also coming exclusively from firms with debt. And what is even more interesting is that this dampening effect of having delinquent debt is not only active there, but it kicks in much earlier than for investment, right? So this dampening effect takes place much earlier after the shock. We believe that this is related to the fact that firms borrow to pay part of their working capital, their labor. Okay, so let me now shift gears to the model. So just to fix ideas and to set expectation, what is it that we want to do with the model? We want to build a model that can help us rationalize these empirical facts. And importantly, we want to have a feature that in the models allows us to capture differential degrees of financial access, which to us is relevant for explaining this empirical result. We're gonna use non-convex cost of accessing debt, and we're gonna also feature entry and exit from default. So this possibility of losing financial access is gonna be present throughout the model. And we're gonna, with this model, try to quantify the extent to which the presence of this possibility of losing financial access matters for the transmission of monetary policy. So let me mention a few key ingredients of the model. So we're going to have a fixed mass of firms that are going to be making investment and hiring decisions to produce a unique good using DRS technology. We're going to try our best to fully account for the life cycle of firms, so to account for the fact that they very slowly accumulate capital. So we're going to have quadratic adjustment cost in investment. We're going to have idiosyncratic shocks to TFP. And these firms are going to die at an exogenous probability rate of omega, right? So new firms are going to replace these firms that die. These new firms, when they're born, they're not going to have access to debt markets. They can gain access to debt market after paying a one-time cost for accessing this. And after paying that cost and being able to issue debt, they can have the possibility of defaulting, in which case they incur in a productivity loss and can re-enter with some probability. After that, investors recover a fraction psi of their debt. So what is essential for you to retain from this setup is that we're going to be keeping track of three types of firms. The first kind of firms are firms that have access to debt and are in good standing, right? So they haven't defaulted, they can issue debt. The second type of firms is firms that have never accessed debt markets, so they haven't paid this one-time cost. And then the third type of firms is firms that did pay that cost, did borrow, and are in delinquent status, okay? And hence have been temporarily excluded from markets. Yep.
You know, there are some firms that are very innovative and may not have a lot of guarantees, but they are very risky, but more in the technological sense, not because they don't pay and so on.
Yeah.
Would they fit in those categories?
Yeah. So we're going to have a heterogeneous TFP. So we're going to have this dispersion of TFP. So you can think of a very productive firm that is borrowing precisely because it's very productive, right? Now, what does the firm eventually decides to do with that is going to be determined by future productivity shocks, right? So if that firm, very productive firm, receives a sequence of negative shocks, that might lead that firm to default, right? So monetary policy is going to be captured in a very simple way here. There's going to be a one-time unexpected increase in the real rate. And so far, the analysis is going to be in partial equilibrium. Yep.
Permanent? Permanent increase in the real rate?
No.
One period?
One period.
Okay.
One period.
And then back.
Yeah. Okay, so I'm running out of time. The idea was to walk you through the dynamic problem of these three types of firms. I'm going to skip this in the interest of time. Let me just say an important element in the model, which is the lenders here are risk neutral, the lenders who provide funds to this firm. The price of the debt is going to be directly influenced by the probability of debt. This is very important because the probability of default is going to be directly mapped to the spreads that these firms face. So higher firm level interest rates are going to indicate that firms are going to have higher risk of losing access to debt, right? So we're going to be looking at the distribution of rates, that is the distribution of risk in this economy. Okay, some parameters we take from the literature. This is not terribly exciting. There are some other parameters which we calibrate, trying to match some targets. I don't have the time to go through each one of them. For instance, a key parameter is this fixed one-time cost for accessing debt. Perhaps more important is what are the targeted moments. So we have 10 targeted moments. One that we care much, we care about all, but one that we particularly pay attention is this share of firms with debt as per the motivation that I mentioned. So this is critical that we're targeting this share of firms that eventually have debt. But there are other moments associated with delinquency status, with leverage that we want to match. And the calibration so far, this is preliminary, does a reasonably good job in matching the 10 moments. Let me jump to the quantitative experiments that we do with this model. First, as in the data, we see what happens after a monetary policy surprise. On your left, you have the path of investment. On your right, employment growth. And as you see, the model can reproduce this stark difference that I showed earlier in the empirical result between firms with access to credit and firms without access, that in the model are firms that haven't accessed yet, or firms that access but are temporarily excluded because they are in default. So the model has the ability to match this important finding of the financial channel. But of course, we want to go deeper into this, and as we do with the empirical results, by looking at firms with access to debt, but looking at the heterogeneity in firm risk. By looking at, for instance, or comparing what happens between less risky firms, some firms with low interest rate, and firms with high interest rate, more risky. Okay? And what we do here in this experiment is we shock the model following a 50 basis point shock. On the left, we have a decrease, so an expansionary monetary policy surprise, and on your right, a contractionary monetary policy surprise. And what is interesting, and is one of the lessons we draw from the model, is that there is an interesting asymmetry. When there is an expansion of monetary policy, so that is on your left, firms with high interest rate, so risky firms, expand investment less than less risky firms. Okay? But the opposite happens when a contractionary surprise hits. It's firms with high interest rates, so more risky firms, that reduce investment the most. Okay? What is going on here? So the next obvious variable to look at is what happens to debt, right? So this is the model-based impulse responses associated to these two types of shocks, expansionary on your left, contractionary on your right. And what you see is basically these firms that are more risky are increasing debt, in the case of an expansionary shock, less than relatively less risky firms. But when the monetary policy contraction shock hits on your right, they're deleveraging higher at a more, with a stronger force. So can we validate this process or this fact in the data? So this is where we go back to the data and we see the following. So what we're trying to do is we go back to the loan level information, and what we ask is, what was the pass-through from the surprises to the firm's interest rates after a monetary policy surprise? So we go back to these three episodes, so these three surprises. We have two expansionary surprises on your left and on your right of minus 25 basis points and 50 basis points in 2013 and 2019. And what we see is that in these two episodes, the riskier firms get a larger rate cut, right? So the pass-through is stronger for them. In this case and in this case. What happens in the contractionary shock that we have?
Andrés, can I ask you a question? So there's no feedback in the model between, say, an expansionary monetary policy shock and the aggregate economic conditions, or say the productivity level, the aggregate productivity level of firm.
No.
Okay.
There is no feedback. No.
Okay.
So what we observe in the contractionary surprise in the middle is that riskier firms deleverage so much that the risk actually decreases. That's why you have this result here, which is below zero. So we think that this is evidence that validates this default aversion mechanism that the model taught us. So this is where we're still working on in trying to tease out some of the policy implications of this. One obvious policy implication is that the distribution of risk, that is, what is the mass of firms that have high default probability vis-a-vis those that have relatively less, matters for the conduct of monetary policy. So in a tightening cycle, it should matter whether firms are more or less indebted. And that this is where we are working in polishing policy counterfactuals. So let me, in the 40 seconds that I have, let me conclude by saying what is it that we find in this paper. So we identified a set of facts in the data that we believe offer strong evidence of a financial channel. in the transmission of monetary policy. There's a strong pass-through from monetary policy surprises to rates at which these firms borrow. After these surprises, there are significant and protracted effects on investment and employment at the firm level as well. These largely impact firms with debt, so we are able to identify that these important dynamic responses come from firms that have access to debt, and that the ability to borrow, this heterogeneity in financial access, matters for the response of firms to monetary policy surprises. And we develop a model that we believe helps us rationalize some of these facts. And essential to the model is this fear by firms of losing financial access. And that has the potential to shape the way the firms respond to monetary policy surprises. Let me stop here and thank you very much for your time.